All right. October 1st. Sorry, bumping my desk. We are into cooler weather and baseball, which October is my favorite time of year for I was born in October and baseball is full swing. Sports, all things sports are starting up again. Football and basketball and all good stuff. I'm gonna wait for folks to jump in here. Give me just a moment, and I'm gonna do things a little bit differently today because it's the beginning of Q1, and I'm gonna find we've got, or I'm sorry, it's beginning of Q4, not Q1. Hello. I'm just trying to talk and look for something at the same time, and that's not working. So, all right. Looking for There is a end of year Q4 playbook that we created that I wanted to kind of walk through today. So if you're thinking, hey, it's end of year, last month or last few months of the quarter or the year, um, I'll find that here in a second. So we're going to walk through today some information around coming down the stretch, last 90-ish days of the year. So what should be on your radar right now, thinking about, hey, what coming into the beginning of the year, what should I be doing, right? Um, so we are going to be talking about a handful of kind of tax strategies that you can execute on and put into motion. And I can't find that doggone playbook, so I will be winging it a little bit. All right. So thank you for being here. Your time is incredibly valuable. I kind of monologued while I was looking for that thing, but let's get started. So it's October 1st, 2025 at the date of this recording, right? So we're into Q4 of the year. Hopefully your year has been jamming along and things have been profitable this year, or maybe you're coming into your season, whatever that looks like for you. So, the last 3 months of the year, what should we be thinking and considering? So, the first thing that we should be considering is uh, this is not sexy. It's not fun. People don't like to hear this, but getting organized, right? That's one of the pillars of the Clear Edge framework is getting organized. So when I say getting organized, what do I mean? Well, this is your opportunity to, if you don't have your bookkeeping fully dialed in, if you don't have your record keeping fully dialed in, this is your opportunity to kind of put out your hand, slap yourself on the wrist, and say, hey, let's get this done, right? Getting your books in line. And the reason why I'm leading off with getting your books in line, it ties directly into all of the other year-end moves that you could be or should be making. So understanding, hey, what is my inflow? What's come through the door revenue wise? What have I spent already? Expenses. Maybe can't tell you in the almost 20 years I've been doing taxes, how many times clients are like, oh, I forgot that this one credit card that I use isn't linked to my QuickBooks. So, they got to scramble and pull that credit card report and integrate those expenses, right? So now's your opportunity to say, hey, let's get our numbers in line and figure out where have we been for the year historically with our numbers and where do we think how we're gonna end the last quarter. I personally like to set my New Year's resolutions and my goals uh, in October. I like to kind of start the last quarter of the year with my goals and my habits kind of forming for what I'm going to be working on in 2026 or the next calendar year. I like to get those formulated now because then I can launch into the new year with full momentum, ending the last quarter of the year with full momentum, and beginning that new year with full momentum. So that's really part and parcel to mitigating your taxes is understanding what your numbers are, right? Revenue and expenses. Once you understand that, here's the next thing you should be thinking of. Everybody's talking about bonus depreciation. It's back. Awesome. That what does that mean? That means we get to deduct potentially on qualified assets, things that you purchase for your business, computers, office equipment, machinery, certain types of assets. We can deduct 100% of that as a write-off. That's amazing, right? We can take 100% write-off, but by getting your numbers in line, by pulling your information forward and saying, okay, what do I have revenue wise? What is my tax situation going to look like based on the numbers that I've generated income and expense wise through quarter three and beginning into quarter four? You may be running out and making a bunch of purchases on equipment and stuff that you don't need, right? Or maybe you don't need to make those equipment purchases, or you don't need that bonus depreciation deduction. So going back to getting your house organized and pulling your information together, that is uber important and very critical to proper tax planning and the proper mitigation of taxes through things like the bonus depreciation, right? So now that we know, oh, we need to get our numbers together to say, hey, is that a good move? You can say, all right, do I need equipment? Do I need any um, big purchases or assets that would help me leverage my business? Have been putting off that computer upgrade, right? Got an email from a client that's looking at a high-end computer, like $6,000 is what they're looking to spend on a laptop, right, for their business, which is insane. But for what they do, heavy graphic in editing and different things like that, they're needing that kind of a machine, that kind of firepower for their computer. So that's one of the year end moves you can make that's tied back into the one big beautiful bill, or OB3, that passed here this last July, right? Now it's been a few months, almost 3 months since that passed. So, getting organized and getting your financial house in order to understand your inflow, understand your outflow. Hey, what has come around for expenses? That's super critical to then saying, okay, do I want to make those equipment purchases for bonus depreciation? So, strategy one and two, getting organized and bonus depreciation. Strategy three, going into again quarter four of 2025, we've got 90 days left to sprint through the end of the year. Uh, an area to look at once you've gotten your numbers in order and your financial house in order, and you understand, hey, here's where I'm looking at profitability wise. uh, I'm a big advocate of, sure, purchase equipment if you need it. But I had a guy come to me once and he's like, Chris, if you tell me to buy any more crap, I need to use the word crap, but he's like, if you tell me to buy any more crap, I'm gonna turn around and walk out the door. I've got enough machinery and equipment. I don't need to buy stuff for tax. Like, it doesn't help me that much. It doesn't, I need to buy a bunch of stuff for tax purposes. And I said, you are absolutely correct, sir. There are many other things you can do. So one of the things you can do that's an easy win going into the last quarter of the year is you can identify, when you've spent the time looking at your numbers, looking at your inflow and outflow for the year. Now you can identify, hey, here are expenses that I incur on a monthly basis pretty consistently, right? You can evaluate, hey, where am I spending money consistently? And you can actually prepay. So the IRS has this safe harbor rule where you can actually prepay up to 12 months in advance. Now, you can't, if it's October, you can't pay through December of next year because that's prepaying more than 12 months. So you want to say, hey, I want to maybe put those prepayments off until December, but you can actually prepay expenses up to 12 months in advance to get a tax write-off now. You can count that. This is if you're cash basis, you're not accrual basis. So if you're already keeping your books on and taxes on accrual, this strategy is not for you. But if you're a cash basis, like many taxpayers are, that prepayment of expenses up to that 12-month safe harbor is what allows you to take a big write-off now. That's a great area where, if leading into strategy number, we've talked about organizing, bonus depreciation, prepayment of expenses. So now going into strategy number four, which is understanding the impact of your income with QBI or qualified business income. So that was with the OB3, the one big beautiful bill that was passed in July. Qualified business income was given a permanent extension, meaning it was made permanent, not temporary, meaning there's no sunset rule. Like it's not going to expire after a certain time. It's now permanent until the Congress critters, the men and women in Congress decide, hey, we're going to change the law, right? So what QBI is effectively is if you have, let's say you have $1,000 of income, well, the government says, hey, if you meet certain criteria, guess what? We're going to give you a discount. It's like a coupon of 20%. We're going to give you 20% off your income that you have to pay tax on. So instead of paying tax on $1,000, you pay tax on 800. Not a bad deal, right? I like discounts. I like it when I get a discount or coupon, so to speak, from the government. But to qualify for that, you have to keep your income. You have to not be a SSTB, which is a specified service trade or business. Meaning, if you are in a business like my own, right, accounting, tax, law, healthcare, any business where the business really is driven off of the expertise or the reputation of one person or one specific group of people, that would be a specified service trade or business where the government says, hey, we're going to give you that 20% off discount, but as you reach certain income thresholds, that's when we're going to start to withdraw that discount. We're not going to allow that discount. And then if you exceed certain income limitations, you lose that ability to take that discount completely. So this is where prepayment of expenses. Hey, if you're cash basis, you're like, oh, we have a guy right now who we're gonna prepay about 200 to $250,000 worth of expenses this year in December. We're planning that already because that's going to drop him below the income thresholds to where we will be able to qualify for QBI. He's going to get 20% off of his income as a tax write-off. That's huge, right? So getting organized, knowing your numbers, knowing what your inflow and outflow is allows you to then say, okay, what do I have capital wise to, do I need to spend money on equipment? That's strategy number two, right? Strategy number one is getting organized. Strategy two is, do I need to spend money on equipment and take advantage of bonus depreciation? Or would my money be better spent if I don't need any of that equipment, prepaying expenses, right? To keep yourself in strategy number four, QBI range, right? To understand, hey, do I, if I make those expenses, will I preserve my qualified business income? So there's the four kind of year-end moves already that we've kind of, I want to plant the seeds in your brain to say, hey, do I need to be thinking about these things? But everything comes back to that linchpin of getting organized and understanding your numbers. That is mission critical. You need to understand the inflow and the outflow and where your business stands profitability wise. That's what drives quality, concise, and profitable in terms of return on investment tax strategy moves. Okay. The next thing that I wanted you to consider is W-2 income for yourself, because one of the other factors, so this is strategy number five, examine if you're a corporation, a C Corp, or specifically if you're an S corporation, you should be paying yourself a reasonable wage. What does reasonable wage mean? Well, a reasonable salary or reasonable wage is what would it cost to hire your role, the roles that you fill inside the company, the different hats that you wear in the company. What it costs you to replace yourself in those roles? QBI is driven in large part by a variety of factors, income ranges and how much you make, what type of business niche you're in, but also it's driven by how much W-2 salary or wages you are or are not paying. So making sure that you're compliant with the S corporation rules of reasonable salary or reasonable compensation is mission critical. If you have not ever examined your W-2 compensation. If you're an S corporation owner, that's an LLC, taxes an S corp that's made the S election, or C corp that's made the S election, you really should examine that and see, am I paying myself too much? Right? I come across business owners that are paying themselves too much in W-2 wage, and so they're overpaying in Social Security and Medicare, or they're paying themselves significantly too little, which impacts their ability to move on to the next strategy that I'm going to talk about, which is retirement planning. So, W-2 income, how much are you paying yourself in a W-2 wage, impacts your QBI deduction. It impacts how much you pay in Social Security and Medicare, impacts your compliance with the S corporation rules of paying a reasonable salary, right? So that's that's the end of the year, the fourth quarter is a great time to examine how much are you paying yourself or not paying yourself W-2 wage. So the sixth strategy that I want to talk about is retirement planning. So if you are not contributing to, or you do not have a retirement plan set up for your company, the fourth quarter is a great time to say, hey, let's think about that. If you're not offering a retirement plan and you have employees, you may be out of compliance. There are several states that have a requirement to offer, if you have over a certain number of employees, a requirement to offer retirement plans. California is one of those. There is a tax credit. We love tax credits. Tax credits are a dollar for dollar value of tax. So we love tax credits. There's a credit available if you start up a retirement plan for your company. You can claim up to $5,000 per year for the first 3 years when you start a retirement plan. It's not a sliding scale. There are criteria. So if you have over a certain number of employees, the credit is reduced by 50%. But again, up to $5,000 that you can claim if you are starting up a retirement plan. And that is mission critical because if you're looking to re- put money away for retirement, right? If you're looking to reduce your taxable income, a retirement plan is a great way to defer some dollars. It's not going to kick the can down the road a little bit, but it's getting it out of a higher bracket potentially now to be in a lower bracket later. So that's strategy number six, right? So far we've talked about getting organized. And if I sound like a broken record, I'm sorry. I'm repeating that for a reason. Good tax planning starts with and is contingent on knowing your numbers. So having clarity around what is your income, what's your outflow, what are your expenses, how much have you paid yourself, all of that information, because then that will drive, hey, we're in this bracket. Here's what you have cash flow. Here's what we're expecting. We know what bills are coming up on the docket here in the next 2 or 3 months, 12 months. So all those things, knowing and having clarity around your numbers is mission critical to good tax strategy and executing good tax strategy. So the second strategy we talked about was once you know what your inflow, outflow, bonus depreciation, do you need equipment, right? Do you have the resources? Can you handle a payment, right? Because you can claim, you can buy a big piece of equipment, you can buy office equipment, computers, etc. on a note, you can be making payments on those. That the interest is then deductible as an interest deduction, but then you can you can fully expense that item using bonus depreciation before the end of the year, as long as that asset was placed in service before the end of the year. But if you're like, that's great, I don't necessarily need equipment, then we look to the next strategy, which is prepayment of expenses, that 12-month window. You can say, hey, we're going to prepay some expenses. And that again is contingent on, hey, I know what my numbers are. I know what my last 12 months have looked like or 9 months have looked like for expenses. I kind of have a good idea of what could I prepay that will help alleviate cash flow issues, give me a tax deduction now, and help me with cash flow in the new year. So once we go into that, then the next is QBI. We talked about the qualified business income deduction. We talked the 20% deduction there. We talked about W-2 wage for you as the owner. And if you've never done a reasonable compensation study, we should talk. We have a tool that can help you execute on that and really determine what you should be paying yourself W-2. Then the last thing we talked about was the retirement plan and the credit if you are putting money into or starting a retirement plan for your people. Going into the seventh thing that I wanted to talk to you today about, accountable plan. So, accountable plan is a phenomenal way, and this is it's like the best kept secret of the accounting industry. I don't know why, but if you have a corporation, if you have a C corp or an S corp or a multi-member LLC partnership, an accountable plan is a really powerful way to do what we would call lifestyle shifting, right? We could say, hey, where are personal things that have business crossover, right? I use my home, work out of a home office. So if I have a S corp, I'm not paying my rent or my mortgage or my utility bill for my household, my family. I'm not paying all that through the company, right? Because I need to keep my personal and business separate to avoid piercing the corporate veil and commingling, right? They say when you form an S corp or an LLC and make the S election, or C corp and make the S election, you got to keep things separate. Okay, so how do I claim a home office then? You do that through an accountable plan. So if you establish an accountable plan, that's a reimbursement policy that your company is going to specify and say, here are the things that we're going to reimburse you for. Um, Vehicle mileage, if I'm driving around for my business, going from point A to point B, reimbursing on a monthly basis, weekly basis, quarterly, at the minimum quarterly basis, is going to give you a better deduction than, hey, what did we do at the end of the year? And kind of guesstimating. So it really gets you in a pattern of organization to say, hey, we're going to be reimbursing as we go. And I find hands down when I get clients to make that mindset shift over to a more frequent reimbursement, we see that deductions actually go up. And the reason for that is their record keeping has become more systematized. They're touching it on a more frequent basis and they actually pay attention on a more frequent basis. I have clients where we can capture, or we've captured, almost $1,200 a month, 1,200 bucks a month out of their business. That's a reimbursement to them for tax-free reimbursements to make them whole for the business use of their home. So one guy, we covered, effectively almost half of his monthly mortgage. He's like, Chris, this is amazing. Half of my monthly mortgage is being covered by the accountable plan that we've set in place. It's like I'm giving myself uh, almost what, 13, $14,000 a year tax free that I wasn't before. It's like, absolutely. So paying attention to what you're reimbursing or what could be reimbursable through an accountable plan is absolutely mission critical. The next thing that an accountable plan opens up, and strategy number 8 here, is when you institute an accountable plan, you now open the door for something called an employee achievement program or employee achievement reward program. So what that is you can give an employee, and you as the owner of the business can qualify for this. You can give an employee up to $1,600 a year tax free, but it has to be, cannot be cash. You can't pull out and say, hey, we're going to give you, you know, we're going to give you cash money, right? That's not tax free. I'm not a baller, so it's a dollar bill, right? But you can't give them cash. Can't be a gift card, right? It has to be, because that's cash equivalent, can't be a check. Also cannot be tied to compensation. So, hey, Chris, you hit your sales goals or you hit your production goals or KPIs. So here's a little bonus. We're not going to tax it. It's a fringe benefit. That doesn't fly. It cannot be tied to compensation. What I like to do is I like to say, hey, let's examine your core values, right? Integrity, joy, whatever your core values like we exhibit as a company in our culture, like recognize your employees for, hey, you exhibited integrity or outstanding customer service. Thank you for you went above and beyond in this way this quarter. You're a rock star. We appreciate you. The story I like to tell about this one is I had an employer, and his employee had he told her, he said, hey, Janet, I want to give you a gift. Thank you for just being amazing. You exhibit your core value of, teamwork You constantly do these other things for the team members and mentor and coach and help lift our organization. You're an asset that we would be hard pressed to replace. So thank you for being you and amazing. What is it that you would really want that you are like, I can't justify spending that money on myself, right? So often as parents or business owners, we spend money on other people. My wife is like this. She'll give the shirt off her back to somebody, on the street, but at the end of the day, if it comes to doing something and taking care of herself, she's like, oh, I that can wait, that can wait. So he asked her, he said, what is something that you've been just itching to get, but you haven't felt the need to splurge, or you don't want to splurge on yourself? And up to 1,600 bucks. And she thought about it and immediately popped out the answer of, hey, there's this chess set on Etsy. And he's like, okay, cool, send it to me. So he sent her the link. It was like $1,000 chess set. It was very ornate, hand carved. Like he's like, wow, 1,000 bucks for a chess set. Okay, that's what she wants. So got it, popped in the mail at their company. He had a company gathering and he's like, hey, I just want to recognize Janet. Handed to her. She broke down in tears. She broke down in tears because this was the identical chess set that she learned to play chess on with her father when she was a little girl and he was dying of like pancreatic cancer, right? So she just broke down in tears. And for the next 2 years, he told me recently, he's like, Chris, she still talks about that chess set almost every day. She's teaching her grandchildren to play chess on a chess set that when her dad passed away when she was very young, and she has fond memories of him spending that time. And she's like, I'm now teaching my children or grandchildren to play chess on this chess set that's identical to what I learned how with my father, right? That's an impactful, and he didn't even spend the full 1,600 bucks, right? He spent $1,000 to give her something that had real meaning to her and boosted her morale. And he's like, that was the best morale booster. I'm hard pressed to beat that, right? So that's the employee achievement program or award program that you can institute without an accountable plan. So going back to the accountable plan, if you don't have an accountable plan, you're limited to $400 per year per employee, which can still be impactful. But how impactful would it be if you said, hey, Christmas is coming around. Let's go to Costco or go to Target or Walmart. Let's load up the grocery cart with Christmas presents for your family, right? Christmas up to 1,600 bucks is the budget for you and your family to buy something tangible, good, and go, or Amazon, something like that, where you buy a tangible good. So those are some kind of year-end tax saving strategy moves that you can make quick and dirty in a half an hour. I think the chat is still disabled. Are there any questions? Has anybody popped any questions in the Q&A? I want to pause here for a moment. Nope, don't see anything there. Perfect. So if you're watching the replay on this, and the replays can be found in our free school community. So if you go to maketaxesfair.com community/community, that will bring you to our free weekly free tax strategy group community. I'm going to share my screen here. So when you go there, we're going to go into classroom and in the community training. And what we do is we put, you can see cop playbacks of the last weekly workshops. We did an OB3 update. We did an accountable plan and fringe benefits. We talked about the OB3 back on July 10th. So this is where we put our weekly workshops. We're going to be putting our workshop here for kind of year-end tax strategy moves that you want to be making there. And in our VIP community, you can see same thing we have in our VIP community, the latest tax strategy trainings. We're going to be putting in both the free and the VIP. Normally, the playbook that we have that goes along with today's workshop, um, we're gonna actually going to release this to both the free and the VIP. Normally, the playbook or the workbook is only inside of the VIP community. You can check out the details in our free community about how to join that. But that's where we put all of the worksheets, all of the playbooks, all of the resources that are there to help you take action. Inside of the free community, we put the training and so you can ask questions and learn. But the resources to take action are inside of our VIP. And today, we're going to put it in the workbook in both the free and the VIP communities. So, with that, I'm going to check one more time for any Q&A. We dropped, I normally don't like to drop, hey, here's 10 things or here's 8 things you need to do, right? That doesn't lead to good execution. That generally doesn't lead to, hey, let's take action because we already live in a state of overwhelm. I hate the term small business. There's nothing small about being in business. But when you drop, hey, here's 10 things you need to do, or 8 things like we talked about today, that you need to do, it's like, okay, what do I do with that? Well, grab the workbook, grab the that we're gonna drop to help you say, okay, how do I evaluate? Does this apply to me? And what should I do about it now between now and the end of the year? Well, we talked about getting organized and getting your books in line, QuickBooks, bookkeeping, get your P&L, inflow, outflow, understand what have you spent already for the year? What has your income been? What do you think the last quarter is going to look like? Because we're now here on October 1st and we got 90 days till the end of the year effectively. So now's the time to kind of get organized and you'll thank yourself later for spending a little bit of time to get organized. The next thing is bonus depreciation with the OB3 and the hey, we're back to 100% bonus depreciation. So that means if I buy qualified assets, I can expense 100% of those items. Well, you may or may not need to do that. So getting organized and understanding what are your resources available and how do you deploy those resources effectively, that's really the linchpin of good tax strategy and good tax planning. Then we talked about the getting organized, bonus depreciation, prepayment of expenses that you can, for the next 12 months, you can look ahead. So if you're in October and you're like, hey, I'm going to pay through December of next year, you've broken that strategy, right? You can only do 12 months in advance. So prepayment, you want to, if you do make those prepayments, you want to make sure you circle back in December and tack on the extra 2 months, to make those payments into December of next year, right? Because you can only go 12 months out under the safe harbor rules. From there, we talked about W-2 wage and whether or not you're paying yourself. Nope, we talked about QBI, qualified business income, and the 20% deduction that the government gives you, as long as you kind of are within certain income limitations. The prepayment of expenses that helps, like we're using that. A guy he's paying, I think 200 to 250, maybe $300,000 prepayment. He has a lot of large expenditures that come out in the first quarter of the year. So he might be prepaying those expenses to drop his income now. And that will affect your QBI, which the next thing that drives QBI or that qualified business income deduction is your W-2 wages. So make sure you're paying yourself a reasonable salary if you're an S corporation owner. And we talked about retirement plan and how retirement plans can help as you're paying yourself appropriate wages, how retirement plans can institute tax savings by reducing your taxable income, and that there's a credit for retirement plans, which is fantastic. We talked about accountable plan and how accountable plans can open the door for tax-free reimbursements coming back to you to bump your pay tax-free, avoid payroll taxes, income tax, and increase your expenses. And then we talked about the uh, can't talk today, sorry, the Employee Achievement Award Program and how that needs to be not cash equivalent. It has to be a tangible good or item. I'm going to leave you with one last thing when it comes to 1099s and issuing 1099s. So the IRS has released some information around 1099s, who needs to issue 1099s. We're going to be drafting and finishing up an article today that we're going to be posting inside of our school community that will outline, hey, here's what you need to know about 1099s. But here's a pro tip as you're looping back to tip number one, which is getting organized and understanding what the income and outflow is. That's a great opportunity to identify, hey, who have I paid year to date, January through October 1st? Who have I paid that I would need to issue a 1099 to? Or who has paid me where I'd be expecting them to issue a 1099 to me? Now you can run a report and say, hey, uh, I paid Jim. He's a subcontractor of mine. I can run a report and be like, hey, Jim, January through September, it looks like I paid you $90,000, right? Here's the breakdown by month. I also was looking at my records, Jim, and I'm not sure I have a current W-9 for you. So here's what I have on record. Can I make sure that the W-9 that I have on file is correct? Now, Jim gives him an opportunity to respond and be like, "Hey, Chris, thanks for reaching out. I actually have it. I see that you said you paid me $5,000 in September, but my records show, 4,500. Human errors happen, right? So that's where you can say, "Oh, thanks for bringing that up. I'll make sure that's correct. Let me verify. Yep, that looks like an error on my part. I'll correct that." So now you've kind of given 3/4 of the year update on your 1099s that you're going to have to issue, and you can get a updated W-9 to be able to issue a 1099 accurately and promptly when it's coming due in January. So now you have an opportunity you've already done the work to verify 3/4 of the year. So when it comes to issue the 1099, you update for the last quarter of the year. It's less work that you have to do to update that report and then pop out and say, hey, here's your 1099. That helps to reduce errors either for those that are issuing 1099s to you and or that you're issuing 1099s out to others. So there's a pro tip to kind of get organized and put together a system. I typically like to do that either October 1st or December 1st, your call. But that if you verify information and verify, hey, we've got the accurate W-9, we got the accurate payment amount information, either payments that I've received, so I expect this would be my 1099, or payments that I've issued out. Recently went through an exercise with a fella, and we recognized by getting organized and by spending that time, there's actually $129,000 that he thought was applying was included on his 1099 from last year, and it was actually going to fall to this year. Timing issue of when he got paid his commission, right? He didn't realize that he thought that was included in his 1099 from 2024. So by taking the time, we actually picked up on his books. We were able to identify, hey, he had an extra $129,000 that he did not realize was going to fall to 2025, and that adjusted, oh shoot, I that's an extra 100,000 plus income that is going to fall to 2025 that now we need to do something about, right? So we're now looking at some strategies to deploy before we get to year end so that we're not panicking. Because had he not kept his books up to date and had not done that kind of audit mid beginning of Q4, he would have been supplying us with information from his bookkeeper that was not accurate. $129,000 swing in income. Well, that can push somebody into a different tax bracket, right? So good planning starts with good numbers, kind of tying it all back to the beginning. So take a moment, take a breath, enjoy the fall, crisp fall air. Baseball season. I'm a big Cubs fan, so go Cubbies, right? We beat the Padres yesterday and hopefully have a good run. But baseball season's coming to a close, sports, family, holiday gatherings, phenomenal time to pause, hit the reflection button and say, okay, how's my year been? What can I do to recalibrate, to tackle this last quarter strong when everybody else is kind of letting off the gas because of the holidays? What can I do to end my year strong, end my year organized, end my year tax optimized, and start the new year with a bang. Thank you for being here. The goal is to go an hour or less every week. I hope that today we've kind of done a hit list of a bunch of different things. Take note, pause, watch this playback. If you're not in our free tax strategy community, check it out there. Folks, friends don't let friends overpay the government. That's our mantra. We believe that. That's why we're here every week to talk about how you can pay less to the government legitimately. Thank you for being here. If you found this valuable, also share this with a friend. That's all for today. I'm going to get back to it. We're dealing with the October 15th extension deadline stuff. So those that had to go on extension, we're kind of wrapping up. But I'm going to leave it with you here and say thank you for being here again and go Cubbies. Bye for now. We'll see you next week.